Modigliani and Miller proved in 1958 that in a world without taxes, without bankruptcy costs, without information asymmetry, capital structure is absolutely irrelevant. The value of a firm doesn't change based on how it's financed. It's one of the most elegant results in finance. It's also a theoretical result for a world that absolutely doesn't exist. In a world that does exist, with taxes and bankruptcy costs and incentive effects and management behavior all shaped by leverage, capital structure matters enormously. So today, we're going to explain why. Hello, my name is Todd Hagopian, the original Stagnation Assassin, the author of The Unfair Advantage and The Stagnation Assassin, both on Amazon. Today, on the Stagnation Assassin MBA, we are cracking open capital structure. I'm going to tell you what they teach you in the MBA program, what they leave out, and what you actually need to know if you're running a real business in the real world. Every operator who runs a leveraged business or makes capital allocation decisions needs to understand exactly how capital structure actually affects business behavior, risk tolerance, and long-term value creation, not how it would affect an idealized firm in an absolutely frictionless, fictional market. Here's the textbook version. What does the textbook say? And to be fair, again, as usual, it's not wrong within its assumptions. Franco Modigliani and Merton Miller, both Nobel laureates, published their capital structure irrelevance theorem in 1958. Their argument was that if markets are efficient, which they are, there are no taxes, there are no bankruptcy costs, then two firms with identical operating cash flows should have the same total value, regardless of how they're financed. Investors can replicate any capital structure through their own personal leverage so that firm-level leverage creates no additional value. In 1963, M&M revised their model to include corporate taxes. With taxes, interest on debt is tax-deductible, while equity dividends are not, creating a tax shield that makes debt actually valuable. Pure M&M with taxes implies that firms should use maximum debt, which is clearly not optimal in the real world. This gap led to the trade-off theory, which argues that firms choose capital structure by balancing the tax benefit of debt against the cost of financial distress. The direct costs of bankruptcy and the indirect costs of distress, like lost customers, lost employees, lost investment opportunities, that appear before the actual default. The real-world debrief. Let's talk about where this does hold water. Capital structure theory earns its tuition in three operational applications. First, the tax shield is real and valuable. For stable, profitable businesses with predictable cash flows, debt financing produces a genuine tax advantage compared to equity financing. The interest deduction lowers the effective cost of capital and creates value for the shareholders. This is the legitimate financial engineering argument for leverage in the right circumstances. Second, leverage improves capital discipline. Jensen's free cash flow theory, discussed in a later episode, argues that debt is a governance tool. It forces management to generate cash to service obligations rather than accumulating excess cash that may be deployed in value-destroying acquisitions or prerequisites. Appropriate leverage can make management teams more operationally focused. Remember, leverage is a governor on management behavior. With no debt, there's no urgency. With too much debt, there's no flexibility. The right level creates the productive tension that gets the job done. Third, the pecking order theory by Myers and Maloof correctly predicts that companies prefer internal financing to debt and debt to equity because of information asymmetry costs. The hierarchy shapes real financing decisions in predictable ways that operators should understand when they're trying to raise capital. Let's do the operating room, though. Where does this break down? Here's where the professor sits down and all of us operators stand up. Capital structure theory fails in three operational contexts. Failure number one: leverage changes strategic behaviors in ways that the theory doesn't model adequately. A highly leveraged business cannot make the long-term investments, R&D, brand building, customer acquisition, that create future value because cash flow is committed to debt service. This is not captured in the tax shield versus distress cost trade-off at all. It's a strategic capability impairment that destroys long-term competitive position while the financial structure appears on paper to be sustainable. Remember, a business cannot invest in its future because debt service consumes its cash is not financially optimized. It's strategically compromised. Failure number 2. The theory treats financial distress costs as knowable and predictable. In practice, the indirect cost of financial distress, the lost customers who don't want to depend on a financially fragile supplier, the employees who leave for safer employers, the investment opportunities that require capital that you just don't have, emerge long before the legal bankruptcy. And they are very hard to quantify or predict early on. Failure number 3. Optimal capital structure changes with the business cycle and the operating environment. The optimal leverage for a manufacturing company in a stable market is very different from an optimal leverage during a demand disruption or a period of rapid input cost inflation. Most capital structure thinking is static when the environment is almost always dynamic. Let's talk about the operator's upgrade. What are we going to do to fix this? 3 capital structure principles for operators. Principle 1. Stress test your capital structure against a plausible downside scenario. If revenue drops 20% for 18 months, can you service the debt? Can you make the strategic investments you need? If the answer is no, then you're over leveraged. It's pretty much that easy, regardless of what the current financials say. Principle 2, distinguish between leverage that funds operations and leverage that funds growth. Operating leverage borrowed against stable cash flows can be appropriate even at significant levels. Acquisition leverage, borrowed to fund growth bets, requires much more conservative sizing because the cash flows being borrowed against don't yet exist. Principle 3, manage covenant headroom actively. Financial covenants, leverage ratios, coverage ratios create real operational constraints that limit flexibility exactly when you need it most. Building and maintaining covenant headroom is not a conservative financial management. It's actually strategic optionality. Stagnation Assassin verdict here, adapt it. Capital structure theory is correct in its identification of the trade-offs, tax benefits, distress costs, governance effects, but it does require significant adaptation for operating companies. Account for the strategic investment impairment of high leverage, stress test for downside scenarios, and manage covenant headroom as an operational priority. The right capital structure is the one that funds strategic investment while maintaining operational resilience. Theory alone does not find it. So that's capital structure, the theory of how to finance a business, and the practice of how to get that right. For more information on financial strategy and capital allocation, grab The Unfair Advantage and Stagnation Assassin on Amazon. Follow the Stagnation Assassin show and check out toddhagopian.com for the world's largest stagnation database. Remember, the right amount of debt is the amount that improves discipline without impairing strategic capacity. Everything above that is fragility disguised as optimization.